Oh, analysts are not expecting the Reserve Bank's Monetary Policy Committee to be unanimous in its decision on hiking rates this afternoon, while consensus is that the MPC members will decide on another hike. Analysts expect that they will have to, however, be divided on just how high to go. Let's bring in our business editor, Xolani Mbanjwa, who's here to help us look ahead to that announcement, which will happen, by the way, in the next 15 minutes. Xolani, so as I was saying, no consensus, but what are we expecting as far as a range for this increase?
Oh, definitely there's consensus on 75 basis points. But if you look at others like Investec, the Investec Bank is actually saying they're actually seeing 100 basis points on the balance. So there's been this consensus of between 50 and 75 basis points to follow through with what the rest of the developed world is actually doing. We saw the bad news of the inflation numbers that came out yesterday from the Stats SA, with inflation ticking up 0.1% to 7.6%. That doesn't bode well, because a lot of people had anticipated that the inflation hike that we have been seeing would have tapered off by now. But this increase, although marginal, does not bode well when it comes to how we are going to deal with interest rates going forward. So there is a bit of consensus, definitely an increase. And if you look at many other people, economists around the world who are actually keeping an eye on this, they're already putting the repo rate at 7%, taking it from the current 6.25 to 7%, and that's a 75 basis point hike, which is, they did that yesterday. So this is quite tough for the economy, but the consensus is there in terms of how much the growth of the interest rate is going to be. But among the members of the MPC, there hasn't been consensus amongst them. I think in the 5 meetings this year, there's been consensus on one in one meeting. But we spoke earlier on to Redge Nkosi, and he had this to say about his views on how the MPC, on whether the MPC will be unanimous going into this, coming out of this meeting which started on Tuesday. This is what he had to say.
I go along with that consensus about 75 basis points. But again, it's a consensus that we agree, not because we have a clear or same understanding of the reasons behind it, but because some of us think that there isn't anything the Reserve Bank can do because it only follows this particular route. So it will have to raise some rates. If it was conducting itself or conducting monetary policy that's sensible, that's different, we wouldn't even be talking about that. Now, we're talking of the U.S. Increasing its own rates there and us matching similar increases there. It's understandable. Again, it's because we use the interest rate policy, which necessarily is not the monetary policy. If you follow this through, why should we be going along with the U.S. When it comes to increasing their rates? Meanwhile, the U.S. has got so many tools to use for its monetary policy. We only have one. We don't have to compare ourselves with the U.S.
And Xolani, today's announcement will be the last rates decision by the MPC for the year, right? What are we expecting to come in the next year? Because I've heard some of the experts, economists, saying that we could even see more in the new year.
We will definitely see more in the new year, and each and every economist, market analyst that I have spoken to, and each report I have read points to 2023 being a difficult year altogether. Remember, the entire world is expecting still a global recession, and we are not the only country in the world that's battling these inflationary pressures. And to deal with inflation, to put a dent on us running to the bank to borrow money, it's really the tightening cycle will continue to deal with inflation, because it's not good. A lot of people are looking at the Reserve Bank and saying it's good to be predictable. It's good to to be so trusted, but you should not be following what the whole world is doing, following what the Bank of England is doing, what the U.S. Federal Reserve is doing. But you should do your own thing. But
what you're basically saying, Xolani, is if your lover has been saying, let's move in and split the rent, now is the time.
Yes. It's been tough. It's been really tough for consumers. We are speaking, yesterday we spoke to Telkom CEO, we spoke to many other CEOs who are actually talking about the disposable incomes not being there. Even business confidence, the business confidence index that came out yesterday from Royal Merchant Bank, they spoke about constrained finances even with Black Friday and the festive season coming on. There's low sentiment when it comes, negative sentiment rather.
They're expecting like a surge in spending.
No, because of the hard economic times, because of the households being under strain. But this is what Mbanjwa Masilela, is the Chief Investment Officer at Mbanjwa Fund Managers, said earlier on when we asked him about the future prospect, the outlook for interest rates looking into 2023.
It's a definite hike. The question here is by how much? And given that inflation is getting out of control, as we've seen yesterday, but also now if the guys have to look into the Fed's minute, which are saying to us that, listen, we need to slow down. So whether the guys will consider that, and instead of them giving us a 75 basis points, probably they give us a 50. So the question here, remember, these guys, when they make these decisions, they're looking into inflation expectations. And we've seen the main culprit so far has been oil prices, and so far they've been coming down. So if they have to consider that as well, and at least the rent has been strengthening a little bit, probably the guys might not have to be that aggressive when they make the announcement later this afternoon.
And the best way, Xolani, as we wait for that MPC announcement at 3 o'clock, to understand just how much pressure people have been under in the last 12 months or so, is to look back at what has been a consecutive cycle of increases.
Yes, but we need to also still go back to COVID-19. This is where the changes in our interest rate and the surprise meetings that the MPC held in April, in May 2020, slashing interest rates and actually giving money back to consumers. So we are there. We are back now to pre-COVID levels when it comes to interest rates, and the issue here is when it comes to inflation in the past 18 months, it hasn't looked good, and to deal with that hike, really you must deal with it through interest rates. So when you look at the past year, the November meeting of the MPC, that's when we started seeing the hiking cycle in November. Where were we in November? In November it was 25 basis points, 3 consecutive 25 basis point increases. In May this year it went up 50 basis points, and we followed suit in July and September with what the U.S. Federal Reserve had actually done at 75 basis points. And that's what we expect them to actually do, because this is no surprise when it comes to what the interest rates, what they're there for. It's really important to note that commercial banks must keep interest rates at a level which prevents an excessive growth in bank lending. So when you look back as well at where we were in 2020, you will see in this particular next graphic that in November 2021, or we go back to March 2020, we're at 5.24%. April, we went even further lower in May, in July, and it goes on and on because they really tried to put money back into consumers' pockets. But of course, higher interest rates are actually good for those who are saving, retirement annuities, pensioners, but they are not good for those who are borrowing, those who are wanting to go into the housing market, which is why right now it's really, really difficult to get a bond because of how the finances are strained. So it's really going to still be tough times for consumers heading into the festive season. It's going to be tough times at the beginning of the year. Really, finances are stretched, and people are warned to actually look at their spend on necessities and not buy a couch because it's 75%.
It also does
off.
not, excuse me, Xolani, mean that we're likely to see more of the industrial action which you've been reporting on this week. I mean, if interest rates are going up, inflation is up. Yesterday, when you're looking at those CPI figures, meat, bread, milk, all cost much more than they did a year ago. And if wages aren't matching that, instability in the labor market will lead to economic turmoil.
You are 100% right.
I pay attention.
That's what we are expecting next year. The labor unions are going to be demanding more of the money that's not there. And unemployment is expected to take a hit as well in terms of an increase in unemployment because the industry leaders are not seeing a growth in head count next year because of the anticipated tough times. So the workers are going to be demanding more because interest rates are higher, inflation is higher, the cost of living, according to the ProfMed stress survey. There is definitely stress. Number one stress right now is the cost of living. It's no longer COVID-19.
Xolani Mbanjwa, our business editor, he's going to be here to take you through that broadcast when we bring you the address by the MPC, Governor Lesotho, scheduled to speak at 3 o'clock to tell us which way interest rates will go. Let's bring you that live shot. Preparations are underway now for the address itself. That's where I will leave it for today. Make way for Duduzile Ramela, who will be here with Xolani to take you through the next few hours of coverage and reaction to the MPC announcement.